Hey everyone. About a year ago, I highlighted how the pandemic-driven surge in household savings was bolstering consumption and pushing up inflation. Total savings, including money market mutual funds, increased by nearly $5 trillion between February of 2020 and December 2021. And at the time, I suggested that consumption spending wouldn't slow until the additional cash on hand fell back into alignment with the pre-pandemic trend. That meant the higher interest rates being put in place by the Federal Reserve would only have a muted effect on reducing inflation until the excess savings burned off. My thinking was that if people have extra cash in the bank, they'll continue to spend. Once the excess savings was spent, then the higher interest rates would have a greater impact. If you look at the year-over-year growth rate of savings, you can clearly see the surge during the pandemic. That reflects both the injection of stimulus as well as the fact that people stopped spending money on travel, restaurants, activities, and so on. Then as the economy reopened in 2021, there was a massive spike in retail sales growth while the growth of total savings came back down. Savings actually went negative. The total amount of money in savings and money market accounts began to shrink. And as the amount of money people had in savings went down, retail sales growth flattened. And we're now seeing the rate of inflation come down as well. We're approaching a tipping point. Total savings, including money market mutual funds, is back down to about $23.1 trillion. If you extend the pre-pandemic savings trend line, total savings is almost back in alignment with the projected level. That implies total savings is about where it would have been if it had followed a relatively stable trend and we hadn't gone through the pandemic. And as a result, retail sales have begun to flatten, and that in turn is helping to slow inflation. A couple weeks ago, the headline inflation rate came in at 3%, down 100 basis points from May. At the same time, the producer price index was just 0.1%. Basically, manufacturing input prices are flat from the prior year. I suspect this trend will hold in the coming months, even if the Fed stops raising rates after its July meeting. That's because the higher interest rates are starting to bite into spending more now that the excess savings is nearly burned off. In last week's video, I likened the Fed's action to steering a giant cargo ship. And we're approaching the point at which we'll be able to see whether the Fed oversteered the ship or if they've positioned it correctly for a soft landing. We should get a lot of that data before the Fed's next meeting in September. From a commercial real estate perspective, the burn-off of savings and the slackening pace of retail sales growth has begun to reduce demand for retail space. Space absorption in the first half of 2023, while positive, is estimated to be about 1/3 of what it was last year. Industrial space demand is following a similar trend, also around 1/3 of what it was last year. If the US skirts a recession and simply goes into a period of slow growth, as many economists currently forecast, absorption for both property types should remain modestly positive as we navigate the soft patch. Hotels likely face a similar outlook. While occupancy rates have been quite strong, especially considering that many hotels are still operating with a staff shortage, the average daily rates may ease a bit as consumers become more mindful of their budgets and leisure travel slackens. At the same time, the reduced savings levels could restrain home sales, in turn favoring apartment demand. Given the recent rise in consumer sentiment, apartment absorption should sustain its positive momentum. But the big variable will still be the Federal Reserve. Like Wall Street, I expect a rate increase on July 26th. Chairman Powell's comments during the press conference will be telling. Hopefully, he'll suggest the Fed will be data-driven through the remainder of the year and signal that additional rate increases may not be needed. That would suggest the Fed believes inflation is coming back under control. If I could give Chairman Powell one piece of advice, I'd tell him the same thing I tell our clients. Keep your eyes on the horizon.